I'm Ray Dalio. I managed over $124 billion at Bridgewater Associates for nearly 5 decades. I predicted the 2008 financial crisis 18 months before it happened. I called the dot-com crash. I navigated every major economic cycle since the 1970s. And right now, I'm about to tell you something that's going to make a lot of people very angry with me. Stop buying stocks in 2026. Not because stocks are bad, not because the market is about to crash tomorrow, but because if you're blindly following the same advice that worked for the last 40 years, you're about to get destroyed. Here's what nobody's telling you. The environment that made buy and hold work from 1980 to 2020 is over. Finished. Dead. We had 40 years of falling interest rates, from 15% in 1981 to basically zero in 2020. That environment created the greatest bull market in history. Every dip was a buying opportunity. Every crash recovered. Buy the dip worked every single time. But you can only cut rates to zero once. We're now in a completely different regime. And the strategies that made people rich over the last 40 years will make people poor over the next 10. I'm not guessing. I've studied 500 years of economic history. I've mapped every major debt cycle since the Dutch Empire. And I'm reading the machine right now. The machine is screaming at me that we're in the late stages of a long-term debt cycle. These happen every 75 to 100 years. The last one was the 1930s and 40s. Before that, the 1860s. And when these cycles end, they don't end quietly. Let me show you exactly what's coming, and more importantly, what you need to do about it before it's too late. The machine is breaking, and your advisor won't tell you. Most people think the economy is random. Good years, bad years, booms, busts, just chaos. They're wrong. The economy is a machine. It has inputs and outputs. It has cycles, and it's completely predictable if you understand the mechanics. For 50 years, I've studied how this machine works, not just in America, but across every country, every time period, every regime. And here's what I've learned. The economy runs on 3 things: productivity growth, short-term debt cycles, and long-term debt cycles. That's it. Understand those 3 forces, and you understand 90% of what drives markets. Productivity growth is simple. Are we producing more value per person this year than last year? Are we innovating? Are we getting more efficient? If yes, the economy grows. If no, it stagnates. Short-term debt cycles last 5 to 8 years. The economy expands. People borrow money. They spend it. The economy heats up. Central banks raise interest rates. Borrowing gets expensive. Spending slows down. The economy contracts. Central banks lower rates. The cycle repeats. And this is why you see recessions every 7 to 10 years. It's not random. It's the machine cycling. But here's what most people miss. There's a third cycle operating underneath. The long-term debt cycle. Over decades, debt accumulates. Government debt, corporate debt, consumer debt, all of it building up year after year. And eventually you reach a point where the debt becomes unsustainable. You can't service it anymore. You can't grow your way out of it. You can't refinance it at lower rates because rates are already at zero. That's where we are right now. Total U.S. debt, government, corporate, consumer is over $90 trillion. Government debt alone is $38 trillion. That's 125% of GDP. The federal government now spends over $1 trillion per year just paying interest on existing debt, more than it spends on defense, more than it spends on education. Just interest payments. When interest costs exceed defense spending for the first time in modern history, that tells you something. The debt load is unsustainable, and here's the problem. When you're at the end of a long-term debt cycle, you only have 3 options. Option 1, defaults. Governments, corporations, individuals stop paying their debts. Bankruptcy, massive wealth destruction. Option 2, restructuring. Debts get renegotiated. You owed $100, now you owe $50 paid out over 20 years. Sounds nice until you realize if you're the lender, you just lost half your money. Option 3, inflation. Print enough money and the debt becomes worthless in real terms. You owed $100,000 in 2020. By 2030, that same $100,000 is pocket change because the currency collapsed. Great if you're a debtor. Catastrophic if you're a saver. And guess which option central banks always choose? Inflation. Every single time. They'll never admit it. They'll call it quantitative easing or stimulus or whatever sounds less terrifying. But it's money printing, creating currency out of thin air to devalue the debt. And when they do that, the dollars in your bank account, the dollars in your 401k, the dollars you've been saving for 30 years, they buy less, a lot less. That's what's coming. And if you're 100% in stocks right now, you're positioned for the last war, not the next one. Here's what kills me. Your financial advisor doesn't understand this. They've never studied debt cycles. They've never read economic history. They learned one strategy in business school, 60% stocks, 40% bonds. And they've been repeating it for 20 years. That strategy worked brilliantly when rates were falling. But rates aren't falling anymore. Why your 60-40 portfolio is already dead. Let me destroy the conventional advice you've been following. Every financial advisor tells you the same thing. Put 60% in stocks, 40% in bonds. Rebalance annually. Hold for the long term. It's called the 60-40 portfolio. It's been the standard for 40 years, and it's about to get obliterated. Here's why. That strategy was built for a falling interest rate environment. When rates fall, bond prices go up. When rates fall, stock valuations expand. You win on both sides. Perfect, except there's one problem. We're not in a falling rate environment anymore. Rates bottomed at 0 in 2020. They went up to 5% in 2022 to 2022, 2023. And even if they come down to 3% or 4%, we're never going back to 0. The era of free money is over. And when rates rise, bonds get destroyed. A 10-year Treasury bond loses 10 to 15% of its value for every 1% rise in interest rates. If rates go from 4 to 6%, that's a 20% loss on your safe bonds. But wait, it gets worse. Stocks are priced for perfection right now. The S&P 500 is trading at 24 times earnings. That's 50% above the historical average of 15 to 16. In a normal reversion to the mean, the market would drop 30% just to get back to average valuations. And if we get a real deleveraging, a debt cycle crisis, we're talking 50 to 60% drawdowns. It happened in the 1930s. Stocks drop 89% peak to trough. It took 25 years to recover in real inflation-adjusted terms. It happened in the 1970s. The stock market went essentially nowhere for an entire decade. But when you adjust for inflation, which ran at 7% to 9% annually, real purchasing power for stock investors declined by over 50%. Someone who bought stocks in 1968 didn't break even in real terms until the early 1980s. 13 years of zero returns. 13 years of sitting there watching your purchasing power evaporate while your advisor told you to stay the course. It happened in Japan starting in 1989. The Nikkei peaked at 38,000. Even now, 37 years later in early 2026, that market is still working to fully recover those levels. An entire generation of Japanese investors bought into the conventional wisdom that stocks always go up over time, and many of them are still waiting. So your 60-40 portfolio, both sides are broken. Bonds lose because rates are rising or inflation is destroying real returns. Stocks lose because valuations are insane and earnings collapse when the debt cycle unwinds. You're about to get hit from both directions simultaneously. The story nobody wants to hear. Let me tell you about someone I know. We'll call him David. David was 52 years old in 2006. He had $2.3 million saved. He was on track to retire at 62 with $4 million based on his projections. He felt great. He was following all the conventional advice. Diversified portfolio, 60% stocks, 40% bonds, working with a big name wealth management firm, paying them 1% annually. That's $23,000 a year to tell him to stay the course. In 2006, I sat down with David. I told him the same thing I'm telling you now. We're late in the debt cycle. Housing is over-leveraged. Banks are holding toxic assets. A crisis is coming. You need to reposition. He didn't listen. His advisor told him I was being alarmist. Ray's a hedge fund guy, they said. He makes money betting against the market. Of course he's predicting doom. The fundamentals are strong. Stay the course. So David stayed the course. 2007 came. The market kept going up. David felt vindicated. See, Ray was wrong. I'm up another 12% this year. His wife bought a new BMW. They booked a Mediterranean cruise for their upcoming retirement. David started looking at retirement homes in Arizona. He was counting down just 10 more years. Then 2008 hit. His portfolio dropped 52% in 18 months. That $2.3 million became $1.1 million. Everything he built over 25 years of disciplined saving cut in half. He was 54 years old. His advisor told him, don't panic, don't sell, it'll come back. But David needed that money to compound. He needed time. The market didn't fully recover until 2013. He was 59 by then. His retirement calculator showed he was $800,000 short of his goal. He pushed retirement to 65, then to 68, then to 70. Then his wife got sick, cancer. Medical bills piled up. Even with insurance, they were hit with $150,000 in out-of-pocket costs. He had to withdraw from what was left of his portfolio. The cruise never happened. The Arizona retirement home never happened. I saw David last year at a coffee shop near my office. He's 70 years old now, still working, managing a retail store, wearing a name tag, dealing with customer complaints about returns and discounts. He told me, I should have listened to you in 2006, but my advisor said you were wrong. He showed me charts. He showed me historical data. He made it sound so convincing. I asked him what happened to your advisor. David laughed. He retired at 58, lives in Florida now, plays golf every day. You know what kills me about that story? David wasn't stupid. He wasn't lazy. He wasn't reckless. He followed the rules. He trusted the experts. He did everything conventional wisdom told him to do, and it destroyed him. The advisor made millions in fees from clients like David, and when the crisis hit, the advisor's own money was safely positioned because advisors know the truth. They just don't tell you. Don't be David. What the data actually shows, not what your advisor shows you. Here's something your advisor won't tell you. In the 1930s, it wasn't just stocks that got destroyed. It was the entire conventional portfolio. Government bonds, many defaulted. Corporate bonds, massive defaults. Stocks, down 89%. The only people who preserved wealth were the ones who owned physical assets. Gold, farmland, productive businesses with pricing power. In the 1970s, the same pattern. Bonds got destroyed by inflation. The 10-year Treasury lost over 60% of its real value from 1970 to 1980. Stocks went nowhere, but gold up 24x. Energy companies, massive gains. Agricultural land doubled and tripled in value. The pattern is always the same. When debt cycles end, paper assets collapse. Physical assets hold value. And here's what really bothers me. The data is public. It's not hidden. Anyone can study the 1930s, the 1970s, Japan in the 1990s, 2008. But your advisor won't show you this data, because if they did, you'd ask uncomfortable questions, like why am I paying you 1% annually to put me in the same portfolio that failed in every previous debt crisis? They don't have a good answer to that question. What you should own instead, the three buckets. Now you're probably thinking, okay, Ray, you scared me. But if I shouldn't own stocks and bonds, what should I own? Let me show you the three asset classes that actually survive when the machine breaks. I own all three. I've been accumulating all three for the last 18 months. And I'm going to tell you exactly what they are right now. Asset class one, businesses with pricing power. Not stocks, not index funds. Individual businesses that have three specific characteristics. One, they can raise prices faster than inflation. Two, they generate cash flow you can live on. Three, they own hard assets or intellectual property that holds value when currency is being debased. Here's what I mean. In the 1970s, when inflation ran at 10 to 15%, most stocks got destroyed. The S&P 500 went essentially nowhere for a decade. But certain companies exploded. Energy companies that owned oil and gas reserves. When oil went from $10 a barrel to $80, their revenues went up 700%. Their costs went up maybe 50%. Massive profit expansion, massive profit expansion. Agricultural companies that owned farmland. When food prices doubled, farmers who owned the land printed money. Utilities with regulated returns. When their costs went up, regulatory frameworks let them pass those costs through to consumers with a guaranteed margin. Consumer staples with monopolistic positions. Procter & Gamble, Johnson & Johnson, Coca-Cola. These companies raise prices when their costs go up. Consumers complain, but keep buying because brand loyalty is strong. Think about Procter & Gamble. They own Tide, Pampers, Gillette. When their manufacturing costs go up 20%, they raise prices 25%. Consumers might switch from premium Tide to regular Tide, but they don't stop buying detergent. That's pricing power. Johnson & Johnson. They own Band-Aids, Tylenol, medical devices. When inflation hits, hospitals don't stop buying medical equipment. They pay the higher price. These aren't get-rich-quick plays. These are wealth preservation plays. When inflation hits, these companies don't just survive, they thrive. So if I were building a portfolio today, I'd put 35% to 40% in businesses with these characteristics. Companies that own hard assets, have pricing power, and generate reliable cash flow. Not because I'm certain we'll get 1970s style inflation, but because if we do, this bucket protects me, and if we don't, these are still quality businesses that pay dividends. Asset class 2, physical precious metals. Now we get to the asset class that makes conventional investors uncomfortable. Gold and silver. Not gold ETFs, not mining stocks, not paper gold. Physical metal that you own and control. Here's why. Throughout history, every time a currency collapses, gold survives. It's the ultimate insurance policy against monetary stupidity. In the 1970s, when inflation destroyed bond and stock returns, gold went from $35 per ounce to $850, a 24x return. Someone who put $10,000 into gold in 1970 had $240,000 by 1980. Someone who put that same $10,000 into the S&P 500, they had maybe $12,000 after inflation. In the 2000s, when the housing bubble burst and central banks printed money, gold went from $250 to $1,900, a 7x return. In 2025, gold went up over 70%. Silver went up over 140%. The market is already pricing in monetary stress. I keep 10% to 15% of my liquid net worth in physical gold and silver. It's stored in secure vaults. I hope I never have to use it. If the dollar loses 50% of its value over the next 10 years, that gold doubles in dollar terms. It's not an investment, it's insurance. And insurance always has a cost. In good times, gold underperforms stocks. That's fine. That's what insurance does. But in bad times, when your stocks and bonds are getting crushed, gold holds steady or goes up. That 10% to 15% allocation could be the difference between retiring on time and working until you're 75. Asset class 3, short-term treasuries and cash. The third bucket sounds boring, but it's actually the most important. 90-day to 2-year treasury bills earning 4% to 5%, and cash equivalents in high-yield savings accounts. This is your dry powder, your optionality. When the crisis hits, and it will hit, you want cash, because that's when the best opportunities appear. In March 2008, high-quality corporate bonds were trading at 60 cents on the dollar. If you had cash, you could buy them. 12 months later, they were back at par. 60% returns with minimal risk. In March 2020, when COVID panic drove stocks down 35% in 3 weeks, cash was king. If you could deploy at the bottom, you doubled your money in 6 months. The The people who made fortunes in those crises weren't the smartest. They were the most liquid. So I keep 20% to 25% in short-term treasuries and cash. It earns 4% to 5%, barely keeps up with inflation, but it gives me optionality. When everyone else is panicking and selling, I'm buying. That's the three-bucket system. 35% to 40% in businesses with pricing power, 10 to 15% in physical precious metals, 20 to 25% in short-term treasuries and cash, the remaining 25% to 35%, that's where you can take intelligent risks. Real estate, commodities, emerging technologies, whatever you understand deeply. But the core 75% is defensive. It's designed to survive what's coming. How to reposition without getting destroyed. Now, here's where most people screw up. They understand the problem. They agree with the analysis, but they reposition wrong. They wake up one morning, panic, sell everything, buy gold, and sit in cash waiting for the apocalypse. Then markets go up for another year. They miss the gains. Their gold goes nowhere, and they feel like idiots. That's not how you do this. Here's the systematic approach. Step 1. Calculate your timeline. How many years until you need this money? If you're 35 and planning to retire at 60, you have 25 years. You can be aggressive. You can reposition slowly over 12 to 18 months. If you're 58 and planning to retire at 63, you have 5 years. You need to move faster. Reposition over 3 to 6 months. The closer you are to needing the money, the more urgent the repositioning. Step 2, sell the garbage first. Not everything at once, but systematically. Start with purely speculative positions. Meme stocks, crypto you bought because it was trending. Growth stocks trading at 100 times earnings with no profits. Sell that first, this week. Then trim your overweight positions. If you're 80% in index funds, start bringing that down to 40% over the next 3 to 6 months. Don't try to time the perfect exit. You won't. Nobody can. Just systematically reduce exposure to the broken assets. Step 3, build the 3 buckets. While you're selling, start building. Month 1, buy your first position in physical gold and silver. Start with 5% of your portfolio. Month 2, research businesses with pricing power. Buy your first 2 positions, maybe Procter & Gamble and Johnson & Johnson. Month 3, move cash into short-term treasuries earning 4% to 5%. Month 4, add more gold and silver to hit 10%. Month 5, add 2 more business positions, maybe a utility and an energy company. Month 6, continue building until you hit your target allocation. This gradual approach has 3 advantages. 1, you average your entry points. You're not trying to catch the perfect bottom. 2, you have time to learn and adjust. As you implement, you might discover things that don't fit your situation. 3, it's emotionally easier. Small changes over time are less stressful than one massive all-or-nothing decision. Step 4, ignore the noise while you're repositioning. The market will probably go up. Your friends will brag about their returns. Financial media will say the bull market is back. Your advisor will call you and say you're making a mistake. Ignore all of it. You're not repositioning based on what's happening next month. You're repositioning based on where we are in a 75-year debt cycle. Short-term performance doesn't matter. Long-term survival does. I've been repositioning institutional portfolios for 18 months. I started when the S&P was at 40,200. It went to 4,800. People said I was wrong. I didn't care. I'm not trying to win this quarter. I'm trying to survive the next decade. You should think the same way. What you must do this week, not next month. Here's what's going to happen. Most people watching this will nod along. They'll think, yeah, Ray makes sense, and then they'll do nothing. They'll talk themselves out of it. Maybe he's being too pessimistic. Maybe I should wait and see. Maybe I should ask my advisor first. And their advisor will tell them to stay the course. Because advisors make money when you're invested in their funds, they make nothing when you buy physical gold or move to cash. So you'll listen to them because it's easier, because change is hard. And then in 12 to 24 months, when the crisis I'm describing becomes obvious to everyone, you'll remember this video and you'll think, I should have listened, but by then it's too late. The damage is done. You can't undo a 50% loss when you're 55 years old. The math doesn't work. Compounding doesn't have enough time. Don't be that person. Here's what I want you to do this week, just this week. Sit down with your portfolio, actually open it, every position, every fund, every allocation. Ask yourself one question. If we're entering an inflationary debt crisis, will this position preserve my purchasing power? If the answer is no, mark it for sale. Then make a plan. Over the next 3 to 6 months, how will you reposition into the 3 buckets FIDA? Write it down, make it concrete. Give yourself deadlines. Month 1, sell speculative positions, buy first gold position. Month 2, sell 20% of index funds, buy businesses with pricing power. Month 3, move cash to short-term treasuries. Month 4, continue building all 3 buckets. Month 5, hit target allocation. Month 6, review and rebalance. A system, an algorithm, something you follow regardless of what the market does, regardless of what the news says, regardless of how you feel. Because your feelings will destroy you in a crisis. Fear will make you sell at the bottom. Greed will make you buy at the top. Hope will make you hold positions that are going to zero. A system protects you from yourself. That's what I'm giving you, not a prediction, a system. The final warning, I'm 75 years old. I've been doing this for 50 years. I've managed $124 billion through every crisis. I know what's coming. I'm telling you as clearly as I can. Reposition now, not next month, not after you see how Q1 performs. Now, window is closing. We're in stage 7 of an 8-stage debt cycle. In 6 to 12 months, we'll be in stage 8. And by then, it's too late. The people who act now will survive. The people who hesitate will be casualties. It's that simple. It's that brutal. It's math. Turn off this video. Open your portfolio. Start today. Because in 6 months, you'll either thank yourself or hate yourself. Your choice.